Hi, I'm Teresa Powell. I'm here with Todd Novosel with NFM Lending, and I'm going to ask Todd a few questions that many buyers have regarding interest rates and loan types. All right, Todd. So our first question is, how do interest rates really impact the monthly mortgage payment? And are you seeing certain rate trends this year?
Yeah, so this year's been a pretty volatile year where rates have been going up and
Yeah,
then coming down and then going up and then coming down.
it's a roller coaster.
Yeah, it's been a roller coaster for sure. So good rule of thumb though, so that I put my buyers at ease. A 0.5% movement in interest rates, which is a pretty big move, makes about a $60 to $70 difference on about a $200,000 loan.
Wow.
So not significant. Obviously, every little bit helps, but 0.5% change in rate makes about a $60 to $70 difference in payment.
Now, while we're on the topic of interest rates, and although the rates are higher now, there are certain things that buyers can do so that they're not paying the whole 30-year life of the loan at that interest rate, right? So if they make an extra payment, it takes down the life of the loan. Is that correct? How does that work?
One extra house payment made a year will cut about 5.5 years off the life of the loan. So
Wow.
significant impact
That's
with
huge.
very little bit. Other things that they can do is they can look to potentially refinance. So more than likely the mortgage that they're taking out today, in a few years, rates hopefully will be better, and they could look to refinance that mortgage. So they're not just locked in at that rate forever. They can do something down the road to take care of that.
Okay. And then with the one extra payment a year, is that just principal and interest so they don't have to include tax and insurance?
Yeah, they can do it either way. So
okay.
if they do the full payment, it'll actually, I think, bump that up to about 7 years off the life of the loan.
Wow,
But
that's
just
good to
principal and
know.
interest is 5.5 years.
Yeah,
With
that's
the
a
full
really good
payment,
tip.
about 7.
Okay. Well, that's great.
Yeah.
Now, the next question that we have is, can you explain the main difference between a fixed rate mortgage and an adjustable rate?
Yeah, good question. Common myths around adjustable rates. So a fixed rate is fixed for the entire life of the loan. So if somebody takes out a 30-year mortgage, that interest rate is guaranteed for all 30 years. That principal and interest payment is guaranteed for the entire 30 years.
Okay.
An adjustable rate mortgage would be a variable rate, but fixed for a certain period of time. So let's call it a 5-year ARM. What that technically means is that interest rate is fixed for the first 5 years. It's a 30-year mortgage still. Payments are amortized over 30 years, but that interest rate will make adjustments every year after that 5th year.
Okay.
So little things to be concerned with or mindful of, that your payment will be changing.
Now, is the max of the interest rate, is that depending on what it is at that time, like with the ARM? What determines how high it's actually going to go?
Great question. Typically what happens is there are caps that are installed and in place on those, and they're typically 2% each year. So
Okay.
that mortgage payment can't exceed a 2% from where it originally started. However, there's a little technical part of that, is that there's usually a 5 to 6% lifetime cap. So if somebody starts with a 6% mortgage, that mortgage typically won't exceed 11 or 12% no matter what interest rates go to. That first year, though, technically it can adjust the maximum cap that is available, and then from there, then those 2% caps kick in each year. So kind of complex, but that's a really good way of breaking it down quickly.
Now, is rate locking something that buyers should consider, and how does that work?
Yeah, so I'm a big proponent of any time that somebody is in contract and we know the defined closing timelines, that we lock their interest rate for that appropriate period of time. An alternative would be what's called a term called float, where they actually are in contract, we're starting the process, we're moving forward through all of the milestones, but that interest rate has to be locked at some point in time, and the consumer that wants to gamble and hope that rates get better before closing would do something like that. But I'm a big proponent of, let's get you locked in, let's have the defined terms, here's your rate, here's your fees, and there are no surprises come a week before closing.
Yeah, I don't like surprises either, so that's good that you do that.
Yeah.
The last question I have regarding interest rates and loan types is, what are some of the pros and cons of FHA loans versus conventional?
Yeah, so FHA is a government-insured loan, typically more geared towards somebody that may not have the best of credit, a little bit of a lower down payment. You can do 3.5%, and you don't have to be a first-time home buyer, whereas conventionally is typically more geared towards someone that has a little bit of a higher credit score, maybe has more credit history. Minimum down payment with them is 3% if you're a first-time home buyer, or 5% if you're not. So that would be one of the biggest differences between those two scenarios. Interest rates are generally similar, although the credit score is not as important with FHA, so that's why a client might gravitate more towards that program. Conventional, you do have to have a little bit of a stronger credit profile to qualify for better terms and lower fees. Last biggest difference between FHA and conventional, FHA PMI, private mortgage insurance. That mortgage insurance is on for the life of that loan, or you'd have to refinance to get rid of it, whereas conventional, while it's on there for a defined period of time, 7 to 9, 10 years, depending on how much they put down, it can be removed, and it also can potentially be removed in the future if the appraisal comes in higher. They can get a reappraisal to get it removed. FHA, there's just no way to get rid of it other than refinance.
And they can get rid of it within 2 years, is that right? It's 2 years once they open up the mortgage.
That's correct. So they have to wait 2 years to get it reappraised, but after that 24 months, they can actually call into servicing and say, hey, my house is worth way more than I paid. I'm below 80%. I don't actually technically have to be paying PMI, and then the lender can order an appraisal and actually verify that that's the case and actually remove it. So that's
now,
good.
with FHA and conventional, what are the difference when it comes to the appraisals?
Conventional is a little bit more lenient when it comes to the condition of the home.
Okay.
Biggest ones with FHA where a lot of people are concerned with doing FHA financing would be is if the property has peeling paint. That's a really big one that comes up under FHA, or handrails. If you have 3 or more steps, the appraiser is going to call for a handrail to be installed.
Okay.
Those are like the 2 big ones. There's some other minor ones out there, but the 2 glaring ones when you're comparing those types of financing. Condition of the home does have to be a little bit better going FHA, and they could potentially call for like handrails to be installed.
Yeah, I know when I'm on the buyer side of transactions, so anytime I go through a house with the client, I'm always looking to see, are these, if they're a FHA buyer, are these things going to pop up on the appraisal where we know that we're going to need some wiggle room for the seller to be open-minded to repair some of these items, or we're not going to be able to get the financing. So it's really important to make those decisions early on so that you're not going in contract on a property that you may not get the appraisal satisfied.
Yeah,
so
exactly.
Thank you so much for tuning in. We have more mortgage tips and tricks coming your way, so please reach out anytime if you have questions.